Hello, everyone, and welcome to First Command's Market and Economic Update, where each quarter we delve into the important issues of the day. I'm your host, Matt Connor, and I'm joined, as always, by our Deputy CIO, Matt Wiley, and Head Investment Strategist, Dan Murphy. Last time we spoke, Venezuela was the hot topic, but that now seems like a distant memory given all that's happened over the past few months. And as of this recording, on April 1st, the conflict between the U.S., Israel, and Iran rages on. Marines and paratroopers are en route. Hormuz is still essentially shuttered, and oil prices have surged. Now, we are obviously going to discuss the market, economic, and policy repercussions of the conflict. But before we do that, as always, let's set the stage with a quick review of the markets and economy and how they've behaved during the previous quarter, and then we'll dive into what we think comes next. Mr. Wiley, over to you.
Yeah, thanks, Mr. Connor. We definitely have a lot to discuss in this very short new year, as you just outlined. And for anyone that's been watching the news, but maybe not the stock markets, you're probably likely surprised in how well the markets have actually digested the news flow in the first quarter, all things considered. I mean, if you were to tell me that in just several short months, we'd be dealing with a major geopolitical shock, another round of tariff threats, renewed inflation concerns, and some real volatility in commodity markets, I'd probably assume we're in the middle of a bear market, which is technically a decline of at least 20%. But stock markets have actually been pretty resilient. So let's talk through why that may be the case. As everyone now is well aware, in mid-February, right after the annual State of the Union address, the U.S. and Israel unexpectedly launched a joint mission known as Operation Epic Fury against Iran. And that's not a small headline, as Iran is a major player in the Middle East. It's a much bigger deal, for example, than Venezuela, as you noted we kicked off the quarter with. But quite frankly, stocks haven't reacted to the conflict to any significant degree if you zoom out for a bit. That alone is an important message. Investors are taking the headlines seriously, but they're not assuming all of this is going to turn into a global economic shock, which would certainly create a lot more downside. And there's a few reasons for that. First, the economy entered 2026 on very stable footing. We wrote about this a lot in our annual outlook. Economic growth was strong, companies weren't firing workers to any concerning degree, and fiscal policy was really expected to get more supportive as impacts from the One Big Beautiful Bill Act started kicking into gear. At the same time, corporate earnings had just capped off a really strong year in 2025 and already appeared to be broadening out beyond the more concentrated AI theme that had really driven the market over the last several years. So with a backdrop like that, you have to fall back on the market's historical tendency to inevitably look through this type of geopolitical event. Of course, oil prices are probably a bit of a wild card if they stay too high for too long. But quite frankly, even that impact has decreased in influence on the U.S. economy over the last several decades as well. There's a limit to that. If energy prices do get too high and stay there for too long, it could begin to choke consumption from the consumer, but I don't think we're at that point yet. I want to talk quickly about the bond markets as well, because there's been a lot of action there too. In 2025, bonds were actually doing pretty good and had all the underpinnings for another solid year in 2026. But so far, the spike in oil prices has limited that upside to an extent. And a lot of that has to do with inflation expectations, which tend to cause bond prices to fall. As a result, global bond markets have been less of a hedge over the last few weeks, but it's also been a pretty measured move to this point. So that's going to be a risk to watch until we get some clarity on the Strait of Hormuz, which by all intents and purposes remains closed. And if it ends up staying closed in fairly short order, reopening at least, then that risk premium should fade pretty quickly on the other side. One other thing we're having to watch is the Fed, as usual, and how they may react to this. In my opinion, they probably shouldn't react at all. So we're going to have to hope that they avoid their historical tendency to avoid that type of a policy error in the face of a supply disruption. But we'll just have to see if they live up to that. Fortunately, Chair Powell seems to have acknowledged this in his last post-FOMC press conference. And we're going to just hope that patience will prevail. But we'll have to see. So look, at a high level, markets haven't performed great in 2026. But all things considered, I'd still call their performance to this point a win. In fact, if you look at the higher level of volatility that you normally get in any midterm election year, I'd almost say what we're experiencing from a price perspective, energy prices aside, is pretty normal. Did you realize that in the post-World War II era, the average percentage correction for the S&P 500 in a midterm election year is actually in the high teens? It's by far the most volatile year of the presidential cycle. However, it's important to realize that if you had reacted to that historically, you would have missed out on a pretty strong rebound as well. In fact, just a little more context, the average one-year return from the market low in a midterm election year during this period has been almost 40%. And it hasn't been negative over that following 12-month period a single time.
I agree with you, Matt, that the first quarter has been anything but quiet for global financial markets. Investors have had a pretty constant stream of sort of market-shaking headlines. You already mentioned a few, including the geopolitical shock from Iran and renewed tariff threats. I'd also add a couple more things to that list, including sort of concerns around AI-driven disruption and also increasing pressure in the private credit market. And as you said, despite all of these issues, the global stock market has been fairly resilient. Year to date, overseas markets and smaller stocks in the U.S. are actually up a couple percentage points, and large cap U.S. value stocks are about even on the year. The weak link has really been U.S. large cap growth stocks like the Magnificent Seven. These companies have been a dominant force in global equity markets over the past few years and now account for a large share of the market. So their underperformance has had an outsized impact on the index level returns. In the first quarter, they dragged down the broader S&P 500 index to a loss of a little over 4%. If we break first quarter performance into January and February on one hand and March on the other, there's a very clear reversal. In the first 2 months of the year, markets performed quite well. Segments outside U.S. large cap growth stocks saw strong gains, particularly international markets, which were up double digits. But March represented a real turning point. The outbreak and escalation of the Iran conflict triggered a broad risk-off move. Equity markets sold off across regions and styles, effectively wiping out a lot of the gains that had been made earlier in the quarter in most segments of the global stock market. The good news is that when we look beyond the recent price action to fundamentals, the picture remains pretty constructive. In the U.S., earnings are expected to grow around 14% this year, a pretty strong number. And we expect even stronger growth in overseas markets. And importantly, these expectations are not being revised down in response to the war. In fact, what we're seeing is the opposite is actually happening. Even when we exclude the energy sector, which has obviously benefited from higher oil prices, earnings estimates for the other sectors have moved higher in March, particularly in the U.S. and emerging markets. That suggests underlying corporate fundamentals remain solid despite the geopolitical stress we're experiencing. The bond market, of course, has also felt the impact of the conflict. As Matt mentioned, the spike in oil prices has raised concerns about inflation. And in response, bond yields have moved a bit higher over the last month, which means prices have moved lower. For the quarter, though, most segments of the bond market are close to unchanged. The worst performing sector was emerging market bonds, and it was only down less than 2%. Like we saw with stocks, there was a clear reversal following the outbreak of war with Iran. Bonds started the year on strong footing in January and February, but with the outset of hostilities in March, Treasury yields moved higher while credit spreads also widened. That combination led to a reversal, with most sectors of the bond market logging modest losses. So to summarize, I'd say markets faced significant challenges in the quarter, but have really hung in there pretty well. Most segments of the global stock market are flat or even slightly higher on the year, thanks to strength in January and February. The exception to this is the mega cap growth stocks like the Magnificent Seven, which were down more than 10% for the quarter after powering the market for much of the last few years. In the bond market, the war interrupted what was also a solid start to the year, but losses thus far are really minimal. For both stocks and bonds, we understand that near-term volatility could remain elevated, but the longer-term backdrop is still supportive. And we know from history that the impact of most geopolitical events in the markets has been relatively modest and short-lived. So hopefully that gives you a sense of what went on in the markets during the quarter. Maybe now it's a good time to hand it over to Mr. Connor for his insights on what's happening with Iran.
No, thanks, Dan. Okay, so the U.S. is dealing with its third major supply shock in the last year. We had Liberation Day tariffs, we had immigration reform, and now we have oil. I'm not going to regurgitate any more headlines for you, mostly because it's a good chance they change, the backdrop change, at least by the time you watch this, or probably by the time we finish recording the video. Instead, we're going to simply try to assess where we think this is going. So you are all now experts on the Strait of Hormuz, given all the news coverage, probably. You know that 20% of global oil that is consumed each day flows through it, which obviously has wide-reaching effects on everything from agriculture to plastic production. You know that Iran essentially has a stranglehold on it, thus our current dilemma and the dramatic oil spice that Dan and Matt have already talked about. Now, again, like Matt said, we still hold that the oil response is mostly just higher risk premiums, simply the market trying to gauge how long the disruption is going to last, with the expectation that should we come to some sort of arrangement and Iran allows ships to start flowing again, oil should come down pretty quickly. However, escalation is obviously top of mind for anyone watching or paying attention to the region. And by escalation, we really just mean something that would disrupt oil flows more structurally, destruction of oil infrastructure, perhaps. And escalation certainly seems to be on the table. We've got Marines just arriving in the area. We've got more Marines on the way. The 82nd shipping out as well. But that said, there have been, I think, pretty obvious attempts to avoid oil infrastructure disruption so far. And what we have seen has been relatively minor. But that is what Iran is threatening should the U.S. follow through on its ultimatum over the Strait. And it's also what they're threatening if we have boots on the ground near Iran. If that Rubicon is crossed, we shift into a position where it might just take a while to get back to that pre-war status quo in terms of oil flow. And while that would obviously be a little rough for the U.S., it would really hammer, say, Europe and Asia. But we need to zoom out a bit, I think, because Iran is not best understood in isolation. I think it's better framed as, just the latest in a long series of Monroe Doctrine-esque actions to project U.S. power and dominance, more specifically, in our view, to project U.S. power and dominance at China. Liberation Day, Venezuela, Panama, Canada, Mexico, Greenland, now Iran, they all had politically justifiable motivations, but they all also had a direct link to China, whether we are disrupting China's financial flows, an influence in South America, removing their rare earth metal leverage, putting up major roadblocks for its oil imports, or forcing it to take dramatic and, in our view, relatively inefficient actions to maintain its export volume amid the trade war. If that's the case, then the summit that's coming up in a couple of weeks between the White House and Beijing takes on even greater importance, right? It was already delayed because of the Iran conflict. And given that China gets nearly half of its oil through the Strait of Hormuz, it's probably going to dominate the conversation. And while it's very silly, probably, to assume that China comes out on our side in any kind of disagreement that's going on, any pressure at all from China on its key Middle Eastern ally could go a long way towards resolution. And speaking of resolution, we know that DC and Tehran have traded a list of conditions for the war to end. Unfortunately, but obviously expected, both sides see the others as rather illogical. But you have Pakistan taking on the role as a go-between with the backing of now China and various other players, Turkey, Egypt, Saudi Arabia, and they even earning themselves a little bit of oil through the Strait as a reward. Maybe there's more of these negotiations than Iran is currently letting on, which is very encouraging. That said, as Matt and Dan have already reiterated a couple of times, it's pretty difficult to foresee a total end to the conflict right now. That also means it might be a while before we know what the true economic ramifications will be. Because even if the conflict ends, the oil impact can still kind of ripple through the global economy. But we will talk about the economics of oil shocks and, more importantly, as Matt already alluded to, the Fed response in a moment. But first, Mr. Murphy, I'm going to go back to you to help set the stage. Give us some insight on how the U.S. economy is holding up currently.
Okay, thanks, Matt. Clearly, what's happening in Iran has meaningful consequences for the economy, but there are a couple of key reasons why we don't think the war is likely to push the U.S. into recession. First, unlike most economies, the U.S. today is structurally much less vulnerable to energy shocks than it was in the past. And second, the U.S. economy was on pretty good footing heading into the war, and therefore in a pretty good position to withstand some stress. So let me address each of these points in a little bit more detail. In terms of being more resistant to oil stocks, there are a couple reasons for this, and chief among them, as Matt mentioned, is that the U.S. is now a net exporter of energy. A few decades ago, rising oil prices were almost purely a tax on the economy. Today, that's no longer the case. Higher oil prices still hurt consumers at the gas pump, but they also benefit a large and globally competitive domestic energy sector. That creates an important offset in the form of higher profits, more investment, and stronger income in energy-producing regions. Another reason the U.S. is more resistant to oil shocks is that energy simply matters less to household budgets than it used to. If you go back to the early 1970s, as a percent of their total outlays, U.S. consumers were spending roughly twice as much on gasoline and other energy goods as they do today. The decline since then reflects better fuel efficiency, a more service-oriented economy, and broader energy diversification. So even when oil prices rise sharply, as they have recently, the macroeconomic impact is more muted. So let's put some numbers around that. Oil prices have risen about $40 per barrel. If sustained, that translates into an additional cost at the pump equivalent to a little over 0.6% of personal consumption. That's meaningful enough to slow growth, but not really large enough on its own to push the economy into recession. Okay, so less susceptibility to oil shocks is one of the two main reasons we don't think a recession is likely in the U.S. And the second, as I mentioned, is the starting point of the economy. The U.S. entered this period of geopolitical stress on relatively strong footing. If we strip out temporary distortions like the tariff volatility and the effects of the government shutdown last year, economic growth in 2025 was running close to 2.5%, which is really a healthy pace for a mature economy. One of the key pillars of that growth has been investment in artificial intelligence. Large technology companies have been spending aggressively, and that trend is continuing. CapEx for this group are expected to rise from roughly $400 billion last year to over $600 billion this year, a more than 50% increase year over year. That's a powerful tailwind that should support jobs and productivity. We're also seeing signs of resilience from manufacturing. This sector has been sluggish for the past few years, but recently it's picked up. It's still unclear whether this is a temporary boost, perhaps tied to tax incentives like those in the One Big Beautiful Bill, or the start of something more structural. But either way, it provides an additional buffer against external shocks. In addition to business spending on technology and potential manufacturing rebound, we also believe consumer spending is likely to keep expanding with the support of solid wage growth. While wage gains have cooled from pandemic-era highs, they are still running above inflation, which means real incomes are rising. The key to solid and sustainable wage growth is a balanced labor market, and that's where we think we are today. No doubt, payrolls growth has slowed pretty dramatically due to declining immigration and an aging workforce, but we appear to be in some kind of equilibrium characterized by low hiring, but at the same time, low layoffs. This balance should help sustain wages and, in turn, consumer spending. So there are definitely some tailwinds in the economy that should help keep it expanding this year, despite the war with Iran. That said, one area unlikely to provide much support this year is monetary policy. With inflation already running above the Federal Reserve's 2% target, even before the oil shock, and the economy still relatively resilient, we believe the Fed seems likely to adopt a wait-and-see approach when it comes to interest rates. So for more on this, let me turn it back to my colleague, Matt Connor.
Thanks again, Dan. Okay, awesome. So we are on solid footing at the moment. And Dan's already kind of alluded to the recession risk here and why we don't think it's major. But I'm going to go a little deeper on that and kind of give a little historical context as well. So I'm going to start with a scary line. Since World War II, most recessions have coincided with an oil shock. This has led to the idea that oil shocks cause recessions. But as Dan just alluded to or discussed in depth, right, the oil disruptions obviously can have an impact on the economy, forcing households and businesses to adjust their spending. But we're going to argue that the true risk lies with the Fed. And luckily, or usefully, history provides a few great examples of this interaction. So let's go back in time about 50 years. 1973, OPEC, Yom Kippur War, embargoes on Israeli allies, oil quadruples, Nixon sets price caps, and we have those famous gas station lines, right? But it was the decade of monetary stimulus to support the Vietnam War that made the gold standard untenable. And when Nixon abandoned it, the dollar and by extension OPEC's oil revenue lost considerable value. So you could almost argue that cutting supply was almost necessary to combat that. And then on the back end, you had the infamous Arthur Burns letting an oil shock become runaway inflation that required eventual aggressive tightening. Recession number one. 1979, Iran Revolution, oil doubles as at the time that Matt already talked about, the second largest exporter goes offline. Fed Chair Volcker, another famous one, has to step in, crush growth to break the inflation-riddled psyche of the American public. It worked. Got back-to-back recessions. 1990, Gulf War. Oil doubles again. Fed gets worried, halts its rate cut cycle because of inflation concerns, de facto tightening at probably the worst possible time. And there's one more recession in the Fed's tally. 2008, Chinese manufacturing explodes, driving up oil demand, leading oil prices considerably higher. The Federal Reserve, even as Lehman, Freddie, Fannie, Bear Stearns are in dire straits, decides that the inflation picture is again a bit scary and that we should stop easing policy. We know what happens next. And while, yes, obviously we probably would have had a recession based on the housing market collapse, we're arguing that the severity of the recession, so the great part of the Great Recession, was mostly the Fed's fault. Now, what this little trip down memory lane demonstrates is that while oil may set the stage for a Fed mistake, it is the mistake itself that ultimately determines how bad things go. Remember, the Fed has a dual mandate: keep inflation low and stable, obviously, and to keep the economy maximally employed, which really just means avoiding excess unemployment. The problem with supply shocks is that they move each side of that mandate in different directions. So measured inflation goes up and growth gets stunted, which means it becomes very difficult for the Fed to decide on the best course of action. Which side do you support, right? The bigger the impact, the harder it is to navigate. And the risk of policy error obviously goes up. How big that impact is depends on many things, a lot of which we've already covered, right? Oil reliance, or our reliance on oil imports, the oil intensity of the economy, and not most importantly, but very importantly, the economic backdrop when the shock hits, right? Which brings us back to today. And Dan and Matt already hit on a lot of these. I'm just going to pile on a little bit because this is not the U.S. economy of the 1970s. When those earlier shocks hit, the U.S. economy was about a 50-50 split between services and much more oil-intensive manufacturing on the goods side. Now it's about 75% services. There was a near even split at the time between employment in manufacturing and services. Now it's about 5-1 in favor of services. And maybe most importantly, as the real economy has grown by about 300% since 1970, energy usage per person has stayed mostly unchanged given all the efficiency advances we've made that Dan already talked about. So what all of this equals when we think about the Federal Reserve response is a relatively muted oil shock impact that Dan already hit on. So less of a growth disruption and less of a flow through from energy costs to core inflation, which is what the Fed really cares about. By extension, it really just means a slightly less convoluted environment for the Fed to navigate, which is a major plus. That said, the longer it drags on, the harder the Fed's job becomes. And we can't forget the Fed has another job, which is maintaining public confidence in the Fed. That means convincing the public that it can keep a hold on inflation long term. So even an economy that's better positioned to weather the storm doesn't really mean the Fed's job is done. Luckily, inflation expectations have been doing all right despite all the energy price concerns we've seen over the past month. But at the end of the day, the Fed is made up of humans. Humans are prone to error. We all are. So we can't rule out a policy error, which means we can't really rule out a recession. But that said, and Matt hit on this in his opening, the Fed seems to be taking a very productive approach to this shock. They're keeping an eye on down the road to inflation expectations as opposed to over responding to the blips we're probably going to see in headline inflation. So if nothing else, that is useful to avoid the worst of the policy mistakes we've already talked about, which is 1990, which is over tightening during a supply shock and just hammering the economy into the ground. So we just got to hope the Fed is keeping an eye on its own past. So that's the prepared sections, and we'll wrap up. What does all of this mean? So, yes, we may see higher uncertainty for a while. But as Matt and Dan and I have gone through at this point, it doesn't necessarily equal more economic and market disruption. Like we said, the economy is not only starting from a position of relative strength, especially compared to the rest of the world, it is structured to weather this type of storm better than almost any point in history. Markets have shown a lot of resilience in the face of over a year of nearly nonstop geopolitical upheaval. Yes, the Iran conflict, as Dan talked about, has led to a reversal of many of the trades that have been performing well over the past few quarters. The fundamentals are still in the driver's seat, right? Which means that this market reaction is what you would expect to see, as opposed to a risk-off, full-blown panic. It's not ideal. Nobody wants to see down markets, but like we talked about, the oil price being primarily driven by rhetoric and Hormuz delays as opposed to a massive structural shift, it's encouraging. And we just have to wait and see how it plays out. On that note, if you want to stay up to date on how we're thinking about the economy and the stock markets, especially amid all this craziness, be sure to follow us on social media, where we release monthly market musings that kind of delve into what the hot topic is of the month. And make sure you subscribe to this channel to make sure you never miss one of these releases. So with that, thank you for joining us, and we will see you right back here next quarter.